calculate that in when they're trying to invest in the first place, or they don't know any better and they'll learn after a couple bad experiences as angel investors.
How much would an angel typically have? And what do you, I mean, I guess it can be all over, but what's kind of, is there a standard?
It can be all over. I think like Park City Angels were writing average checks of like $200,000 or $300,000, and there were 5 or 6 people in those rounds, right? And some of those people were bigger, so some people were writing $10,000 checks, and some of those people were writing $50,000 checks, right? But most angel groups are not that active. And as an individual investor, you get a lot more leverage. You have a lot more control, saying, I have a check for $300,000. I'm Josh James from Onature. Here's what I want, and here's how I want to invest. Right? And he's got enough time to be able to figure out how the rest of these institutional investing models work. It's like he has a family office, right? It's more like he has his own phone.
So like what he used with Adobe, he then took and he was done for me. He said, I want to do this with it.
Well, it's a little bit different, right? Because when he gets into Domo, he doesn't become the investor in Domo, right? He becomes the entrepreneur in Domo. So he's just going out and doing the same entrepreneurial thing again, knowing all the experience of how the investors are. But he could also be investing in other companies and be the investor instead of the entrepreneur. Once you've sat on both sides of the table, right? The reason this class is so valuable is not that someday you're going to probably be in a venture capital group unexpectedly. Like, your firm gets acquired by a venture capital firm, and all of a sudden you have to do venture capital work. Like, that's like an next to zero possibility, right? The odds of me being venture capital were like close to zero. I got really lucky to be able to get in, but it's not as glamorous as it looks from the outside. Don't feel so bad. There's a lot of people that hate being in venture capital or don't like
the money's horrible, huh?
The money's horrible. Well, you saw the snowman videos, right? I mean, on the upside, the money is really big, but most people slog through and like never make a lot of money and work a lot of really long hours for not a lot of things. But the reason I think this class is valuable is if you ever work for a startup that takes venture capital money, the best way to negotiate with those folks, or to look good to your boss who's negotiating with those folks, is to understand what motivates them and how they work. Right? Having sat on their side of the table, even for a month class, I think will make that a lot easier for you. Yeah.
When you're looking at buying real estate or an asset, a lot of times you'll do some leverage type mentality to get your cash on cash return better. Is there ever someone like Josh James who doesn't really need the cash, but maybe go out and use venture capital funds in Domo or something like that nature where to improve his cash on cash, or at that point is it just too dangerous? You might as well just stay with paying cash yourself or getting a loan through a bank as opposed to venture capital.
Well, to get that leverage, you can get a loan from a bank, right? Because you always have this trade-off. If you're eligible for debt, debt's always going to be cheaper than equity. Because you don't give up any dilution, you don't give up any ownership percentage as an entrepreneur. Right? So ideally, if you needed $4 million, instead of getting $4 million from the venture capitalist, you take $3 million from the venture capitalist and $1 million from the bank, right? Or you take $1 million from the venture capitalist and $3 million. But the bankers are not that sophisticated, so they get nervous if you're like, hey, I was thinking about taking $4 million from the venture capitalist, I'm just going to ask you for $4 million. They're going to go through with your covenants, look at your cash flows and other stuff. You should take it if you can get it, but you probably, if you're thinking about taking VC money, you probably can't get it. You're probably not in a position to be able to get it.
If Josh James were to do that, are they going to loan to him based on his experience?
Sorry, Josh James as the entrepreneur?
As the entrepreneur. Wait, in that example, if he goes out and says, I want to try to raise $1 million through debt, the company obviously they're not going to just go off of his experience, right, because of Adobe or because of Omniture.
They'll give him a little bit of credit for having had a successful investment history. They're going to say that the odds of him losing his money are lower than somebody else. Whether that's true or not, I don't know. But they probably will cut him some slack there. But, I mean, it's not like he's going to co-sign his house for this deal, right? So the recourse to the bank is relatively low.
And that's what they care about.
Yeah, it's probably going to be but they also care about the equity investors that are around the table. So the big bonus for Josh James is that the equity investors that will come up and write checks, and their ability to write follow-on checks is probably those investors are probably relatively good and their pockets are relatively deep for the following. Okay, more questions on this? Let me do this. Suppose, this is not one of your problems, right? But in looking at this 1, G, H, and I, what if this number, instead of being 12 million, has been 22 million?
Then it
Would
would,
it need to be out?
14 of it to go to the investors.
Okay, 14 to the investors, how much does that leave?
8.
Okay. So then you have 8 million bucks. And where does 8 million bucks go?
Percentage of ownership.
Yeah, then it just goes back to the percentage of ownership, right? And who owns what percentage? What does the entrepreneur get?
40.
What's 40%?
3.2.
3.2 million, right? So 3.2 million goes to the entrepreneur. How much goes to the investors? 4.8 total?
Or 1.2 each, plus
Yep.
their liquidation preference.
Yeah, so when you get asked about how much the investors get, remember, you don't want to say 4.8 million total or 1.2 million each, because those investors also get this liquidation preference above. So how much do they get?
Added up 10. 14 plus 4. What's it? 3.2.
4.2 each? No.
4.7.
I think it's 4.7. So I think 4.7 million each investor. How much did they invest in the first place?
2.25.
No,
Okay. So what's their multiple of return?
2 something. 2 point, no.
2.09.
I don't think it's 2.0. Is it 2.09?
2.088888.
All right, I'm just going to call it 2.1. Thanks. They give 2.1 times their money back. That's their multiple of return.
It was 2.8.
108.
2.00.
Yeah, 2.08. Oh,
So it's not 2.1. I'm just rounding out. Question?
So if you had, going back to previously when they sold for 12 million,
Yeah.
if it had been a different set of investors for the Series B and the Series A, would they have gotten their full 2x and there would be nothing left for Series A? Or a minimum, a small amount? Or
Well,
would they have had preference, or would that have been spelled out that they have preference to?
so if you have 4 investors in the Series A round that has a liquidation preference, and then you've got two investors in a Series B round that has a liquidation preference, then you have to know, is one of these more senior to the other, right? Is there some sort of stacking? How does that work?
So that that's outlined obviously when the Series B investors come in, like where they're.
That's totally in the mix, right?
So if it's not in the question, assume that it's no preference. No,
Or just
no-
assume it's the same investment, for purposes of the exam, assume it's the same investment.
Yeah, for the purposes of the exam, I'll be really explicit as to who's in what rounds. I won't give you 2 rounds where there's 2 liquidation preferences for each, and there's different investors in each one, and no description of how the liquidation preferences are treated.
So if a round has no liquidation preference, and then there's a secondary round or a Series B round that does have some sort of liquidation preference,
Yes.
that entire liquidation preference is going to have to take place before anything goes to the non.
That's correct. So in the previous example where we had 3 million bucks back, right? If you, I think this question 1H, what's the multiple of return for each investor?
1.3.
The 1.3, and you get that divided by dividing 3 by 2.25, right? So 3 million is all that's available from the liquidation preference, right? The whole liquidation preference can't get paid. Divided by 2.25, which is the exact dollar amount that came out of pocket for the investor. Gives you that number. All right. Other questions? I think we've done this one. Nobody's leaving in droves. So my recommendation is we'll do this one, and then we'll do this one, and then I'll give you a twist on this one, and we'll see if anybody really still wants to be here. My daughter really wants me to tell her bedtime stories, but if I stall long enough, I don't have to put my kids to bed. I wouldn't do that. Okay, so if the total paid in capital is $12 million bucks, liquidation preference on the Series B is 2x. The company sold for $30 million. All right, and it gives you a summary. 12 million paid in capital, no liquidation preference on the Series A, 2x liquidation preference on the Series B, $30 million sale. What do the investors get? What's the multiple return, and how much is left for employees? So can we use these numbers here?
No.
Or not?
You don't really know. It's Series
Yeah, it's
A.
not 4 million in round A, but how do you know that?
Because the round changed, the paid in capital was 12 instead of 9.
Right. The paid in capital number is different, so these numbers are all going to be different. Right, at least these numbers are going to be different. So what's paid in capital?
12.
12. So the round size is, and the pre-money on the A is 3. Okay, what else changes? Yeah, so these ownership percentages are going to be different. Okay, what is it after ARAP? 70%. So 70% investor total. 30% entrepreneur total, right? 7/10, 70%, 3/10, 30%. Okay? How about for the B-rate? What's the percentage?
33%, 6%
Okay, I can't do it in my head, but if you've got 7 million, so 70% of 10 million is still 7 million, and 7 million plus 5 is 12, and 12/15 is 80%. Pardon? 80%. 80%. 80% investor total. By the way, you guys have to either take notes on this or find somebody in your group, because I don't have a key for this one. All right, and so then what do you have for the entrepreneur?
20.
20, right? But if you don't want to just say, oh, well, 80 minus 100% has to be 20, and you want to check it, you could say 3/10 is 30%. 30% of 10 is still $3 million. 3 divided by 15, or 20% is entrepreneurial total. Okay. Now what do we do?
So, is this sell for?
Figure
Sells
out
for
how much
30
the
million.
preference goes.
Sells for $30 million. Where does $30 million go?
We do 2x Series B liquidation first.
2x the Series B liquidation, which is how much?
10
So it'd
million.
be 10.
Okay, 2x of 5 million equals 10 million, so we'll put 10 million here. That gives us $20 million left. And it just goes to a percentage, right? Once the liquidation preference has been paid, then 80% of 20 million goes to entrepreneurs, which is how much?
16.
Yeah, so 16 million to investor. And how much for entrepreneurs?
4.
Going to check it, you go, well, 20% of 20 million is 4 million, so that should be 0, that matches. That's for the entrepreneur. Okay.
Would they get the 7 million 1x on the first, on Series A? Or you split up the Oh, there's no way.
I didn't completely follow. Do you still care, or are you good?
No, I'm good.
Well, where did the 2x come from?
It's in the question.
Oh, it's the highlighted one there. I keep reading the wrong question.
Yeah.
So like the midterm, I will give you all the parameters. Like the first paragraph will always be the second. And it'll be included in every one of those. So it'll look like there's just an enormous amount of work to do. But once you keep track of it, oh, if I know the paid in capital, then it's this table and what the ownership looks like, you should be able to go through it relatively quickly. Just keep your notes, your scratch paper. All right, so how much goes back to the entrepreneur? That's the last question. That one's relatively easy.
4.
4.
Oh, sorry,
4 million.
So 4 million, right, back to the entrepreneur, that one's easy. How much in terms of nominal dollars that goes out to the investors?
6.5.
26.
$26 million, right? Some of you are gonna say 16 million, you're gonna forget about the fact that there's this liquidation preference. If the question asks, how much does each investor get?
Divided by 4.
6.5.
6.5.
Let's see.
6.5.
6.5
million plus
right?
2.5.
26 divided by 4, 6.5. Okay? And what's the multiple of return?
2.2.
Okay, but you divide what by what, or you get 2.2.
6.5.
Total in.
So you get capital return divided by,
The 3 million, which is 12 divided by 4.
right, and where do you get 3 million?
12 divided by 4.
Yeah, okay, right here. You're just taking the total amount.
Yeah.
12 million divided by 4 is 3 million. 6.5 divided by 3 equals 2.2.
Ish. It's 2.1666.
Okay. All right, questions on this?
Will there be questions where there's a dilution, anti-dilution?
No.
Dilution.
No. I mean, if you had to do this in real life, you'd have to do liquidation preferences. You'd probably also care about dividends, right? Especially if there's a long time period, there's gonna be a bunch of dividends that accrue. The anti-dilution protection actually means that there's a bunch of new shares that get issued. So you wouldn't actually be able to do the math this way. You'd have to figure out, oh, when this down round happens, there's a bunch of new transfer. Some of the money comes out of the entrepreneur's pocket and goes to the investors. Okay? But frankly, in those kind of scenarios, the attorneys are, they have a capitalization table and they know exactly what the dollar amount per share is, and they know literally every single person that has ever had a stock certificate, and they'll tell you exactly who gets how much money. From the investor's perspective, this is really to be able to do the modeling to project how it works. You don't actually have to figure out where the money goes. But it's nice to know. Like, you really ought to check your work, because one time we got a certain amount of money, and like the back office CFO types at the venture firm, this was before Mercado, they were like, great, we're totally happy to have it. And I was like, all right, where's the other $25,000? They made a mistake and they misallocated some of the money. Oops. All right.
Quick question?
Yeah.
This is kind of a refresher. If this same problem were a down round, can you show us the ownership percentage for investors in the entrepreneur? If
So-
it's down to like 8 million?
The thing you wouldn't have to do is, you won't have to do a down round where there's some sort of anti-dilution protection where you get your money back. A full ratchet's actually not that complicated to do, right? Because then you just say, this money goes down, but the investors still own X. So whatever money is missing, that just comes out of the entrepreneur. But I'm assuming what you're saying is, as a refresher, could we do this as a down round where there's no anti-dilution protection, right?
Yeah.
Okay. You won't have anything like that on an exam? So we'll do it really quick.
Yeah, don't take time on that.
You sure?
Oh, if it's good.
So the basic is 3 plus 7 equals 10. Then you have a down round, say that's 5. Then you have another 5 million. So your post money, sorry, people over on this side.
That's all right, we know all the answers.
You got it already figured out.
Yeah, we're done.
So your post money here is 10, right? So your question is, well, where does the money get allocated? Well, it gets allocated after the liquidation preference gets paid on a percentage basis. What percentage do the investors own at this point? How do you do that?
They own all of it.
They don't own all of it, right? Unless there's the anti-dilution protection.
70% of the 5 million plus their initial investment.
Yes, that's how you do it, right? They own 7/10 or 70% of 10 million, which goes down to 5 million, but they still own 70% of 5. And what's 70% of 5? Is it 3.5?
Yes.
So this you can really split up into 1.5 plus 3.5 plus 5 million new money equals 10. So what percentage do the investors own? Yeah, or 85%, right? 8.5 divided by 10 equals 85%. And if you want to check the work, what does the entrepreneur own? Yeah, 1.5 out of 10 or 15%. Okay, that make sense? Okay. All right, other questions? Should we do this last one?
Yeah.
Okay, so let me go back up to this paragraph up here. Suppose the investors don't agree on supporting the company, and 2 investors decide they're going to participate in the Series B, and 2 investors do not, right? What happens when you've got investors that disagree, especially when there's some sort of potential downward risk in the company? Philosophically, what happens?
Hurt feelings.
Hurt feelings? How do investors express their hurt feelings? Like big group hug and like, it's totally fine, you're not going to stick with us in the company.
Hug it out.
Yeah,
Stack each other in the back.
Strongly worded letters.
They don't have to have a lot of lawsuits and strong worded letters because they have actual mechanisms to express how they feel towards the other investors. And what are those mechanisms?
You don't get any.
Title.
Well, and how do they not?
Liquidation preference.
It's the liquidation preference, right? What happens in the liquidation preference?
You give yourself a big liquidation preference in the Series B where they're not investing.
Yes.
So basically, if the company sells, you get your money back and you screw the other guys over.
Essentially, but it's not a screw over, right? I mean, literally the market's beside this. The company can go out into the market and say, we want to raise money from somebody new. The fact that there's bad news really means that it's really difficult to get somebody new in, or it's going to be really expensive. You'll take a big down.
I think in your heart, you're screwing them over, Ken.
Donkey or horse head in the bed.
Yeah. Reference to Godfather for those of you that are, under 30, which is all of you. Here you go. All right. Okay, so the liquidation preference is frequently one of the big mechanisms that gets used here, right? To punish the investors who drop out, not to punish the company, right? If you have a big down round and it falls to the CEO, how does the CEO get punished?
He gets revived.
Booted.
Yeah, he gets removed. He probably gets fired, right? He or she. But in this case, really the investors are punishing the other investors that drop out. Okay. So if you've got paid capital, 12 million, and the liquidation preference on the Series B is 4x, and the company gets sold for 20 million bucks, where does the money go? Well, because the paid capital is 12 million, this ownership percentage model is the same for the previous problem, so we can leave this whole piece on board. But we'll have to do this piece differently. $20 million. What gets paid first?
Liquidation preference.
Liquidation preference, and what
Series
multiples
B.
of liquidation preference, and how many dollars are involved?
20 million.
Series B.
4 times Series B, and how much money is Series B?
5.
$5 million
That's it.
equals 20 million.
Game over.
There's no money left. That's what I was.
Poor early investors.
All right, suppose, it's going to go back to that, they're able to squeak out an extra $1 million. Okay, then there's $1 million left. Where does $1 million go?
Percentages. Ownership, which is actually different than what we
It is
have up
different.
there.
Yep.
Well, per owner, it's different, I should say, not.
The
per
round B
all
guys
investors,
get-
but it's-
Yeah. So the trick here, there's a couple ways to do this. We'll do it both ways, right? What's the investor total if you split 70% up by each investor?
1.75.
Yeah. 17.5% each, right? 70% divided by 4, right? How about this 80%? Is that number still valid?
No.
Nope.
Right. That number is not valid. Okay, what do you want to do there?
Well, for the people who invest in round B, they get their 17.5% of 10 million plus
Okay.
whatever they invest in Series B.
Right, so for C and D, what does C and D get? Those are the investors that drop out. What's their final ownership percentage?
17.5.
How do you figure it out?
Okay, so you're going off of the information that's in the question right above it.
So I'm taking this sentence, again, this would be a lot easier on the
Okay.
file.
Okay.
And adding it to this line.
So you have some questions that only apply to the top paragraph, and then this one's like,
You just take that one.
So
This
Series
is-
A would, they just own that 17
Since it was a flat round,
5%.
you
Oh, wait,
just
no, it's
basically
just
take the
diluted.
1.75 and divide it by the 15 million, which gives you the 11.67% ownership.
It's true, but since they might not be a flat round on the final.
You wanna complicate
You
things.
could also think through and say,
17.5%.
they own 17.5% of 10 million, which is $1.75 million. And if they don't invest anymore, so 1.75 divided by 15 equals,
11.67.
okay, 11.67%. That's for C and D, right? How about for A and B?
They're gonna get 1.75.
Yeah, they're gonna get 1.75 here plus 2.5, which is how much?
28%.
Well, hang on, what are those two numbers if you just add those two?
4.25.
4.25 divided by 15, which equals
28%, about
exactly?
28.33.
I think it's, oh, you're right.
28.
It's called 3%. Okay, so what happens if you add 11.67 for investor C and 11.67 for investor D, and 28.33 for investor A, and 28.33 for investor B? What do you get?
a number.
What number do you get?
You should have 80.
You should have 80%, right? Because when you add those numbers plus 20% for the entrepreneur, it should add up to 100%. This is a complicated problem, right? This section will be the hardest thing you'll do on the final, right? It'll be, you got different classes of investors and they do different things. So you have to really think through, I have a liquidation preference, where's it gonna go? And then on the round financings, you're gonna have to say, who really puts each of these dollar amounts in? And you'll have to keep track of the ownership percentages coming across.
So that last $1 million just gets straight out based on percentage?
Yeah, so in that case, A and B are gonna get $283,000 apiece. C and D are gonna get $117,000 apiece. And the entrepreneurs are gonna get $200,000.
Not quite, right? Because A and B will actually get 10,283,000.
Yeah, sorry, I'm just talking about out of the liquidation. If you want to calculate a multiple of return, then for investors A and B, you have to go back in and add 10 million bucks. Right. So let's go ahead and do that. If you want to figure out the multiple of return for investor A, how much money do they get back in dollars?
10,283,000.
Yeah. 10.283. And how much money do they spend?
They're
4.25.
4.25, right? So they get about 2 and 3. I'm guessing on this.
2.4.
2.4. And investor C and D are going to get $116,000, but they invested how much?
1.75. Better than nothing.
0.07. 0.1.
It's more than 1, isn't it? Isn't it closer to 2?
0.066.
0.06.
0.066.
Something like that. Less than 18%.
That was like 6%. 6%, yeah, 0.06.
Oh, sorry. And this is not a percentage.
Yeah, sorry, percentage-wise, it's 6.6%.
That's a multiple. They get 17 cents on the dollar, between 17 and 18 cents on the dollar.
So how common is it to have such a high liquidation preference in like the real world?
I think I mentioned that when I went to go visit the guys that wanted to buy Biomicro, they had 6x and 7x liquidation preferences in their current cap table. And they totally told me with a straight face that I should take I should trade my company for common stock. It's an interesting business model, right? You just go out and you pitch dumb investors all day long about how they're going to give you the thing they have.
You just need one person to say yes.
Yeah. This is the like Jack of the Beanstalk, or like Jack of the Beans. He gives up his donkey, and his mom like hits him with a stick when he gets home. Only the beans aren't magic.
The beans are real, yeah.
All right. What do you guys want to do? You want to do more math? You got more high-level questions? You had enough preferred stock use for one of
If we
you.
can do all of these problems, we should feel pretty good about going.
If you can do these problems, you'll be very comfortable with the work on the term from the last question.
The math at least, terms would be, yeah.
Say again?
With the math at least, terms would be, yeah. This is all that's.
Is there gonna be any material that's from like the videos that was not in class that's gonna be or?
There's not any questions from the video content that on things that we didn't discuss in class. Although, like we discussed in class on what those terms do, you'll have to know the definitions. You'll be able to match up the description of the preferred term to the actual title. Or you'll have to be able to look at some function of the preferred term and match it to the title. And just to make it more difficult, there's not an exact number of things to match up to an exact number of things. There's actually some extra things in there that don't get matched. You're welcome. All right, I think that's it.